Good morning. Welcome to Meet the Masters of Insurance. I'm Lawrence Geller, founder of For Advised Only. This is a webinar series with Canadians who've dedicated their careers to learning the art and science of insurance sales and service. Webinars in this series are now scheduled through the end of this year, and more are being added to the schedule regularly. Over the years, I've observed that every successful insurance agent whom I've met has succeeded differently, even if they're in the same field, deal with similar clients, and even if they're related or in business together. This is what makes the sale and servicing of insurance one of the best careers that I can imagine. It's possible to become a success in our business with diligence, integrity, and experience. With this webinar series, we intend to prove that any type of person can succeed with time and hard, thoughtful work. Our goal is to create a video record for each of these masters of insurance, so that some of their expertise and experience will be available to anyone who'd like to learn from them. Today, we have Polson Bourbonniere with us. Paul graduated from Western University in 1976 with an honors BA in Actuarial Mathematics. Upon graduation, he joined North American Life Assurance Company, Nalico, at their Toronto University branch. Paul holds a number of designations, including the Chartered Life Underwriter, Certified Financial Planner, Chartered Financial Consultant, and Chartered Investment Manager. Paul is also the past president of the Toronto CLU chapter. He's past chair of the CLU Institute and past chair of LUAC, Life Underwriters Association of Canada, which is now Advocates. He's a member of the Toronto Estate Planning Council, and he served as the board chair of the Conference for Advanced Life Underwriting, CALI. Paul is a partner with Kirk Polson in Polson Bourbonniere Derby Wealth Management, a Markham-based firm specializing in retirement and estate planning. Paul prefers to sit on his client's side of the table. He says helping clients be worry-free, preserving their wealth, and supporting them through all stages of retirement was, and always be his raison d'etre. He then goes on to say, but we can't do that if we don't understand the context of their lives or what they want their money to do. A partnership with Polson Bourbonniere Derby provides the confidence to set life plans in motion and prepare for the worry-free retirement experience that his clients deserve. Retirement can last 30 years or more, and Paul and his team are committed to guiding clients every step of the way. They're proud that their advice is not colored. Oops, sorry. Blowing that, haven't I? By product manufacturers. Too often, the advisor is either conflicted or under pressure to make quotas. Because Paul and his team sit on the same side of the table as their clients, that never happens. Paul is married and has 2 growing daughters, as well as 4 grandchildren. They also have 2 granddaughters, and that's the cherry on the top. He's an avid long-distance runner and has successfully completed a number of marathons. Cancer took both of Paul's parents, and he participates in the Ride to Conquer Cancer every June. He also supports the Scott and Yonge Street missions and Covenant House. In the financial services sector since 1975, when he joined the Manulife Actuarial Department as a summer student, Paul has no plans to retire. He says having interesting conversations with interesting people and solving interesting problems energizes him. He's as committed as ever to sitting right beside his clients at the table of their lives. I'll be interviewing Paul. Good morning, Paul.
Good morning, Lawrence. Thank you for this opportunity.
My pleasure entirely. And I'm glad that you could join us today. Paul, I've known you for a long time. I didn't actually know that you had a degree in actuarial mathematics. Is that
Well, I did. It was really a toss-up between actuarial science and engineering. I've always loved math. I hate to admit, but it's true. And at the time, I had a family connection. My dad was with Crown Life, the late Crown Life, and always was a big fan. He went through the field system. He was an agent. He was a manager, and so he suggested that engineering, fine, but there was more entrepreneurial opportunities. Now, at the time when you're choosing a program in university, the concept of entrepreneurism is a foreign concept. I mean, sure, we all had paper routes and the like, but the fact that you could set your own course and use any skill that you might have in arithmetic and mathematics intrigued me, and off I went.
But then when you graduated, you joined North American Life as an agent. How did
Well,
that
I
happen?
discovered that you need a very, very cooperative employer because of the number of hours required to study all the actuarial exams. And I mean, literally, you don't produce any productive work for months or years until you get your designations. And at the time, computer assistance was in its infancy. I mean, we were literally doing, people won't even understand this concept, something called time sharing with a master computer based in Atlanta, Georgia. I mean, to have a desktop was 10 years into the future. So it was a lot of sitting there literally at a keyboard. And that I understood very early was not what I wanted to do. But I thought, I've got this background. I'm interested in the entrepreneurial aspect of business. And at the time, I didn't realize, but I found out later that I really enjoyed working with people. And so North American Life had a Toronto University program designed to recruit university graduates, sort of an easier backdoor way of getting into insurance sales. And I'll never forget my first insurance sale, and the assistant manager who was with me on the call said, "You realize what you just did? That's a nice sale." And then after we were in the car, I mean, typical 1970s, driving from a house call, and he said, "You've just made, X thousand dollars." You're kidding. Whoa, this is kind of neat. And I was hooked. Didn't take much.
So where did you find your first clients? Was it Project 100? What did you do?
Well, we did Project 100, but we also subscribed to mortgage leads. There was a service I remember called TELA, TEELA, and I believe it was from there. We also had newlywed lists. The whole idea was they were hiring you for your so-called management potential, I guess. How they determined that, I have no idea. So they weren't shy about providing lists of names that you could work. And this was a newlywed list. And yeah, that we had something that at the time my manager, North American Life manager, Jeff Jennings, called the Money Facts Talk. And the Money Facts Talk was sort of a version of You'll Earn a Fortune. And so to ask for a monthly commitment was the close. And to get $100 a month out of somebody at that stage of life in 1976 was a substantial premium commitment. And so that's how it went.
I remember at the time taking a jar to people's houses and say, put $1 a day in the jar, and at the end of the month, I'll be back. And if you have 30
Sure.
bucks, you can afford mortgage insurance.
Yeah.
100 bucks was quite something for newlyweds. So,
And then it took, a lot of financial press to finally convince people of the miracle of compound interest. Well, we sort of learned that on day one. As you say, put money away, and wonderful things happen if you do it consistently.
a lot of the people we've spoken with really started by trying to get into the business market. Did you do that?
The short answer, I guess, is no. In fact, I remember one of the early sales seminars that Life Underwriters put on featured this gentleman, Jim Burton from Prairie Pacific Insurance. It wasn't even PPI then; it was Prairie Pacific, and he spoke about how to get into the business market. But at that point, we were having very good success, sure, with the mortgages and newlyweds. But the one thing North American had to its credit as a marketing tool were these association group plans, and they were either professional associations, alumni associations, and other groups, and they would sponsor both group term insurance. Often they also got the disability coverage and group RRSPs as well. So they had really an interesting way. And the nice thing about those programs is that they were terrific door openers, but for the successful people that we ran into, they were never enough. It was great to top up to, 500,000 or $1 million of term insurance, but as we know, even back then, for people who were successful or had ambitions to be successful, they wanted their own coverage. They wanted something that they could own, that would last a lifetime, and it wasn't just an invoice you paid once a year, but it actually built value. And that was a relatively easy conversation, because if they said, well, why should I own this when I can own that? The obvious answer is, well, someone in your circumstances needs both. So yes, rent cheap stuff for the temporary, but you need a base that is yours, that's permanent, that builds value, that builds equity, that they can't take from you, and they can't, if you decide to pursue another occupation and leave your current association, that it won't be left behind. And so that was an interesting, and but it was a terrific way to meet. And the nice thing about the engineers, a lot of them ended up owning their own businesses. They would get into engineering consulting, and in fact, a lot of them, the jobs that I saw them when they were working, really had very little to do with engineering. Engineering got them in the door, and then they built the business and became CEO. And those were the roles that I was dealing with when I talked to those people. So that was my entry into the business, indirectly, by sort of following their professional careers. As I said, the engineers were the big one, accountants were one, veterinarians were another, and then, as I say, some university alumni associations. We did a lot with the Queen's alumni. We didn't have the Queen's alumni plan, but we got involved with a group that was doing financial seminars for Queen's grads. And that coincided with a time when, not so much talking about insurance, but at a time when prevailing interest rates allowed insurance companies to offer guaranteed lifetime, well, at the time, to age 90 RIFs at 11, 12%. And needless to say, for anybody who wasn't, that was an easy sale. And so we found that talking to older grads about retirement plans built that side of the business up very, very significantly.
That'd be an awful lot of people to speak with one-on-one. Did you do it by seminar, or did you actually just take the list and call
Well, we did it by seminar. When I say we, it was interesting because this organization partnered with probably half a dozen insurance agents in the Toronto area. There just were that many graduates, or Bell Canada retirees was another group we did seminars for. And yeah, the numbers were significant. So sometimes you picked up a lead by virtue of geography. Sometimes it was a conversation you had over coffee after the seminar. I mean, however you made the link. But in fact, that's where I met my future business partner, Kirk Polson. He was one of the insurance agents who was also working the retirement market at the time. And we knew each other from CLU classes at OISE, and then we bumped into each other again at these retirement seminars. And at that time, we had different relationships with other producer groups, but the idea of creating a firm that specialized in retirement income planning, built on insurance principles. And that's so important, because at the time, the only competition in the retirement income market were banks and trust companies. And there's lots of trust companies. You go down Bay Street in Toronto, and every window had an interest rate pasted to it. And it was purely transactional. No concept of needs-based, no concepts of building a relationship. So we took the training that we had received from our respective insurance companies, and that whole idea of broad concept questioning and understanding needs, and we brought that to this dimension of holistic financial planning called retirement income planning. And it wasn't long before, as I say, we were getting obviously a lot of referrals. It's pretty easy to say, I got 12%, where did you get? But what was interesting is, because banks and trust companies were restricted because of deposit insurance to 5-year terms on their interest rates, and the insurance companies were offering 20 and 25-year interest rate guarantees that for people who recognize the incredible opportunity of 10, 11, 12% locked in until age 90, the insurance license and the insurance ecosystem, if you will, was the perfect place to grow a retirement income business.
I remember in 1982, I think, North American Life offering what used to be called a single premium SFPRA, single premium flexible retirement annuity. Something
Yes.
like a 20-year guarantee at 18.1%.
Yeah.
And talking with you, and you said it was like shooting fish in a barrel.
Oh, it was remarkable. Having said that, I can remember um, having a conversation with a client about locking in at 18%, as you say, and the individual who, interestingly, professionally was a commodities trader for Nestle, and he said interest rates are going to 30. Why would you lock in at 18? And I just kept in touch, and he ultimately did lock in when the rates had fallen back to only 16. But the other product that at the time was interesting, and so the genesis of the insured annuity came around was the life annuity, and I'm always I chuckle because I remember being approached by a major publicly owned television network in this country that had a consumer show, and their angle on the consumer show was how life annuities were a ripoff. And would we like to comment on that? Or and the answer is, well, considering the underlying interest rate is 16% on these annuities, and today rates have fallen to 12, I'm not sure I could find anybody that would complain about a lifetime guarantee of 16%. So I don't even know if that show was even produced. But but that was another sort of dimension that we pursued, because to get those annuities we didn't know just how incredibly valuable they were. But for those clients who were concerned about the estate value on the annuity, the advent of term to 100 allowed for the insured annuity concept, or as we call them, the lifetime GICs. And that was, I mean, to this day, when I see, clients with annuities, staff knows, well, let's go see if there's an insurance policy in there, because if there's a $100,000 annuity or a $250,000 annuity, there just might be a corresponding insurance policy. And sure enough, often there they are.
So how did the progression, I mean, you're talking here about retirement planning, which really has become your focus.
Mm-hmm.
You're really an excellent life insurance agent. How did you integrate the two at the start?
Well, it's interesting. The As I say, part of it, kind of the seeds of it, were those group RSPs that were also offered to the associations in addition to association group term life insurance. So, as I say, the brochures are there, the kits are there, and almost despite any efforts. But I was intrigued with the concept of um, total needs planning. I mean, we used to say that actuarially, the most likely thing to happen is that you're going to live to a ripe old age. Uh, then was disability, and then was premature death. So from an actuarial point of view, if you will, I was playing the odds. And I also understood that when people die and large life insurance proceeds are paid, something has to happen to that money. When the family receives $1 million or $2 million tax free in a lump sum, and virtually nobody used settlement options. I mean, it was literally a lump sum. Um, that money could walk out the door, could go across the street to a competitor, or we could devise a process to sort of square the circle, to make it a an ecosystem, if you will. So and then we discovered that there wasn't a lot of competition in the disability insurance market. I'm talking to one of the great disability advisors in the country, Lawrence, yourself, and so you knew the market back in the 1980s, and you were are extremely successful in that space. And of course, we had a number of carriers who have since amalgamated, and as with everything else, we're down to just a few players. I remember Mark Daniels, CLHIA, chair in the late 1980s say you're going to see 5 players in this industry in 10 years, and he was bang on probably to the day. I remember one time I had my personal portfolio was insurance from 5 different carriers, and without doing a thing, it became one carrier in the space of 5 years. And I just kept getting these documents saying that it's now a so-and-so's policy. So it was really quite interesting to watch that. So there's total needs, and then you would start to so that was the strategy, if you will. And fortunately, with single case releases, it was easy to get permission to deal with other carriers. I mean, all these things that we've forgotten about that we had to deal with back then. So whether it was disability insurance or permanent insurance or annuities, we could get releases and we could place them wherever it was appropriate. Then you have the economic factors, as I say, of the high interest rate world. And that spawned on the insurance side. Of course, it spawned the advent of universal life. And I remember North American's first universal life called a future protection. The only account it offered was daily interest because daily interest was paying 19%. Why lock in money at 10 and 12 when you can get 19%? So that was the froth. And of course, everybody was stripping out money from their permanent insurance policies their whole lives from way back when and socking the money in across the street at these trust companies. So the insurance industry responded. Software was developed to manage universal life. And it became a very interesting product, of course, until interest rates settled back down, and then the advent of permanent of whole life resumed. So that was the economics of the 1980s. How do we take advantage of these high interest rates? But by that point, people were starting to retire. Clients that we had met in the 1970s were now getting close to retirement age, and we were being referred to other family members, their parents. And as interest rates were falling, I mean, they plummeted below 10% in 1990. What was an investor to do? And Dan Richards coined the phrase the GIC refugee. And so these people that had never gone near the stock market in their life, never gone near a mutual fund or a segregated fund, whatever. Well, I can remember in 1976 when I was getting my first training, segregated funds were pointed to, and I remember my manager saying, but nobody ever touches these things. Like, you can get 10% guaranteed, so why would you take the risk at the stock market? And of course, at that time, the stock market was languishing because interest rates were so high. So it was, for a lot of people throughout the 1980s, nobody went near the stock market. And then in the late 80s, early 90s, some advisors were dabbling in segregated funds and even actual mutual funds. Nobody went to the pure securities market. That was still the buy, sell, on the 4 hot tip at 4 o'clock in the afternoon thing. So we never got that far. But the idea of looking for alternatives to traditionally relying on interest rates sort of opened up that whole area.
Now, about that same time, you got really involved in LUAT, the Life Underwriters Association of Toronto, didn't you?
Yes. The more I got into the business, and at that point I'd been around for 10, 12 years, the more I understood, or the more I believed fervently that it was a profession that required knowledge, what we used to call front wheel knowledge, as opposed to back wheel. In other words, you had to know the technical as well as understanding the people. And I felt that at the time, the Life Underwriters Association was an organization that, I mean, we had cut our teeth on the Life Underwriters Association training course, which for the first 2 years was still one of the great programs, inventions, systems that LUAC had provided. You've got room, we had 6 or 8 rookies from various insurance companies, a moderator who, was relatively senior, but was willing to share. You'd meet before your day began I think for our case, it was every Thursday morning. And you had action projects, so you actually were accountable to the group. and you shared ideas, and it was just absolutely spectacular. So I really felt a kinship to what LUAC was all about, and it was about professionalism. This was before we had to get politically involved through CALU. This was before CALU was even thought about. So LUAC was a combination of professionalism, knowledge, camaraderie, and it really was a community before that concept began. But it really um, allowed you to just learn. But understanding how much learning there was to do, I felt that, and then I was contacted by somebody from the Toronto chapter or the Toronto LUAC saying we'd like you to serve on the board, and I view that as an incredible compliment. So we all have egos. I said sure, I'd love to help out, and that's where I met the likes of Ted Polsey and some trying to think of some of the others at the time.
Warburton,
Ted Warburton was there, and yeah,
and
and
Angelo
great people.
Delzano, Rudy
But to
Fedorczyk.
see these well-known, I mean, I would call them giants of the industry, spending time to volunteer for this organization was absolutely remarkable. Everything from the education programs to the Ontario Sales Congress, and I remember, I think Toronto at the time was the largest or the second largest association in the world after New York City. We had about 2,500 members just in the Toronto market, which is remarkable. And so the synergies and the programs they put together was, so once you get involved in the Toronto National Board comes knocking. And then Cindy Bowden, a shout out to you. Thank you, because you said she was on the CLU chapter. And I always felt the model was a little upside down. I always felt that perhaps the sort of the university should be the CLU, and the designation drove it. And then if you were an LUA member, your goal should still be to get the CLU. And to this day, it's still the designation that provides the insurance, technical knowledge that's required. The CFP has sort of kind of become a catch-all designation. Life agents get it, and money people get it, but the one that focuses on the insurance is the CLU. I'm proud to have it. I do my CE credits. It's on my business card, and it's I think it's just an important thing, and everybody who's participating or watching this, if you're looking, I mean, the cynic would say it's a great way to get CLU or to get CE credits, but you'd be surprised, regardless of how experienced you are, how much you learn out of the CLU program, and I highly recommend it. It's an important credential.
You felt like you had to do a lot of balancing time, though. You were still a relatively new agent with a young family, and here you are as president of the association with 2,500 members, doing the Ontario Sales Congress, setting up things like that. How did you balance your time?
Well, I remember, I don't know who it was, but whoever it was said that if you want to get something done, you give it to a busy person. And I will admit, I mean, it was pretty frantic. Although the year that I was LUAC chair in 1994, it was one of my best years ever, production wise. And so that was intriguing. But at the same time, I stumbled across a well-known coaching program, the Strategic Coach, and it was they refer to one of their phrases as you hit the ceiling of complexity, and I certainly realized that I had to, if I was going to do this, and I knew the industry involvement was temporary, and it just came along at that time. But I also recognized that organization generally and becoming more efficient was going to be good for my long term, if for no other reason than to create more free time and more family time. So I began what is still a current involvement with Strategic Coach, and there are other coach programs out there, but I do speak highly of them because one of the devices, or one of the provisions is the, the branch manager and the branch environment that was so common in the insurance industry back then is less common now. So to have programs and tools to keep you organized. Some people are natural organizers, others do need the structure. I find that I appreciate the structure that an external program. In this particular case, the nice thing about the strategic coach program is he built his business working with life agents. And so he's very aware of the industry and the challenges to the industry. And I think that's useful because too often consultants, when you hire them, the first thing you do is spend a lot of time and money teaching them about your business. And so in this case, there was already some prep work had been done, and that was very useful.
So you started with Dan Sullivan pretty early on.
Apparently, I am his longest connected client. So they say. I have no reason to doubt that, but it's 35 plus years. And at renewal time, I sort of look at and with the once again, with the relationships that I've created and formed with some of the other clients, and the tools that are presented is a value proposition that each year I assess, and each year I feel is good value, and I write the check and move on.
You are, as far as I can tell, a great believer in collegiality, in spending time with others in the business and sharing knowledge. You and I have been members of a study group together, certainly since the mid-'80s. And you were in LUATC, the training course, which is a study group. In the CLU, you were in a study group, but as far as I understand it, the strategic coach is actually a form of study group.
That's true.
Recommend?
Well, I remember Ben Feldman, the late great Ben Feldman, at one of these sales congresses said, the amazing thing about the insurance business or sharing is that if I have an idea and you have an idea, we each have one idea. But if we share those ideas, we each have two ideas. And I thought, well, like, duh. But that is such a simple thing. And I for those who are concerned about, well, bumping into people and having your own creativity used against you, the number of times that I've gone head to head with another insurance agent on a case, and I see my material being used against me, I can count on the thumbs of one hand. The marketplace is so big. And what's interesting, I'm finding, is that particularly for insurance cases, is that, and in the business market, I don't think there's the saturation, if you will, for want of a better term. More people that are running businesses that have never seen an insurance agent, or certainly not in the last 10 or 15 years. It's absolutely remarkable. So to worry that, I want to keep this ID to myself, because don't forget, the deal is you also get an ID in return, and that you can then use and take advantage of or build on or massage. So I think that's just the approach you have to take. There's no, well, increasingly, maybe there should be some trademarks and patents on some of the concepts that you come up with. And that's an interesting area because intellectual property is increasingly becoming important. But even if you don't go that far and you just, why don't you try this? And as I say, karma looks after you. It comes back. It's just, and I think it's maybe sometimes it's the personality. Some people are very private, very sort of control freaks. One of the many concepts from coaching that I picked up on is this concept of collaboration. And if you don't want to take on and become an expert of absolutely everything that you need to do, I mean, we wouldn't think of offering legal and accounting advice to a client. We would much prefer to have the lawyer and the accountant in the room, or at least in the loop, so that the advice is coming from them, and we behind the scenes agree that that's the approach to take so that we all speak from the same song sheet and that we're all reinforcing the recommendation. Much more powerful than to get into tugs of war and or trying to assert yourself as the dominant advisor. And you don't need to be that way.
So at about the same time, mid-90s, 30 years ago or so, you guys are in retirement planning and you're going straight ahead in this year. That becomes your focus, you and Kurt. And you have competition by this point because the alphabet houses were out there. Every trust company was trying to bring in advisors to work with people. What sort of competition did you have?
Well, in the very early days, mid 1990s, let's say. So Kirk and I, we got together in 1997. So, sort of 95, 96. So we're in that period where the banks and the trust companies, first of all, they still exist. So the trust companies are still lining Bay Street as they always have. They're still putting up their numbers in the windows, but they haven't quite figured out relationship selling yet. They're still transactional. They're still pushing the best interest rate, and they still are dealing with interest rate product alone. So we're not quite there yet, but we are starting to see some early advisors dabbling in call it the stock market based stuff, the segregated funds, and even as I say later on the mutual funds. But it's fairly easy for insurance advisors to just kind of go across the hall and find out a little bit more about the seg fund offerings. Things like MERs and the like just wasn't part of the vernacular. It was, how did it do last year? Oh, that's pretty good. That's better than the interest rate I'm getting, and off you go. So it was very, very much Wild West stuff. But the concept of bringing a planning dimension, and it's interesting because that was pre-software. There was no Razor Plan or FPS or Naviplan or any of these programs were not even thought about. So we would build our own kind of spreadsheets, and it was trying to find somebody who could work with Excel and things like that was interesting. But we could see that just the concept of having an independent retirement income boutique, very few other advisors, and of course, the market was mammoth, so it didn't really matter if there was 100 other firms. But the goal was, when we got together, let's build the preeminent retirement income planning firm in the GTA. And to do that, we knew we had to have a mutual fund licensing. We could just sort of see that you didn't, when you dress like a hammer, everything looks like a nail. And we didn't want to be able to say, don't buy that because it's the wrong thing for you. Well, that's what we wanted to be able to say, not, well, we don't have that license, so here's something that's almost as good. We just wanted to take that whole licensing conversation off the table. We wanted to make sure we could do anything if necessary. And as it turned out, that was wise, because people who were moving their accounts to us, we would look inside and, oh, they've got these things called mutual funds. We better be legally and knowledge-wise able to deal with these things, because whether they're appropriate or not, they're there and the clients bought them. And if we want to look after the client, we can't say, well, we can look after everything except that. So we had to kind of wrap our arms around the existing portfolio as well as the client's needs and circumstances.
You and I have a core philosophy, which is shared. And that is, we both sit on the client side of the table, and our job is to ask the questions they would ask if they knew what we know about insurance, or in your case, retirement planning. How did you develop that philosophy?
Well, I guess that's a combination of, it's sort of like a fish, does a fish know it's in water? Between study groups, between the CLU courses, the sales congress events, there was still a lot of learning events sponsored by Life Underwriters of Toronto, Strategic Coach. One of the great questions, and this is not meant to be a commercial for any particular coaching program, but if you ask the client, today it's 2024 and it's October 2024, and let's go down the road 3 years. So it's October 2027, and let's say for these past 3 years we've been working together on making your retirement worry free. What do you want to see happen to your financial and personal circumstances for you to say, you know what, that was a pretty good idea to get involved with Polson Bourbonniere Derby back in 2024. And so that's a looking at it from the same side of the table, I guess. It's they will tell you what they're expecting, and it's not a competition to sort of say, well, this is what you should have. I don't care if that's not what you want. If they give you their shopping list of criteria, then uh, that's your those are your marching orders. If some of them are unrealistic or in conflict with each other, there's where the conversation goes. Or if some of them are wildly impossible to achieve. But and one of the things that we're doing now, because one of the areas that I'm sort of delving into as we deal with these folks, if you told me the percentage of clients that I work with today who are over 90 it's not a trivial number. And what's interesting is one of the questions I ask is of a new client is who's the oldest person in your family? And sometimes you'll get a, well, our family is cursed with heart disease, and we don't have anybody over 82. And so right away, you know where they've put their exit year. And conversely, we'll get, well, Uncle Fred is 102 and still going strong. He still, walks a mile a day, and he's great fun and sharp, and he's always the life of the party. So now you know where their head is at. And so part of, I think, of our, the holistic thing, and this is really getting away from the financial dimensions, is that, and more and more is being written about longevity. And one of the key aspects is to have a why. Like, why do you get up in the morning? What's the purpose to your day? And you made reference earlier to the fact that I have no plans to retire. Well, my purpose is talking money and health span and wealth span to folks in their 60s, 70s, 80s, and 90s. And I look forward to having that conversation as a peer well into my 80s and 90s. I mean, as long as you can add value to the conversation, why not? If I sit in the corner and kind of drool and have my bow tie, but you and I both have learned from people well into their 80s and 90s. I mean, the late Joe Dickstein, bless him, was just tremendous source of wit and insight right to the end. And so it's not like physical labor where at some point your body can't handle the strain. Every day we know more than the day before. Every day we have more potential value than the day before until and unless some disease such as dementia starts taking that away. And of course, that's a horrible disease, and we don't have anybody who's recovered from that to say what it's like. But if you can improve the odds of health and alertness, every day you have more to share than the day before. So why not?
Well, we have Bill Bell and Ross Durant coming up in the coming weeks, and they're great examples of people who are still very much with it, well into their older years.
That's right.
It's easier to deal with people in their 70s and their 70s, as we now know. But you started in your 30s. That couldn't have been easy. There was always a generation gap. How did you bridge that gap?
I think it was sheer ignorance of the fact that, yeah, I'm asking a 60-year-old to make decisions based on the recommendations of a 30-year-old. Thank you to those people that did that. As I say, that I think that was just literally the ignorance or the audacity of that concept. But don't forget, that was probably, well, demographically, I'm a baby boomer. So that 60-year-old saw 30-year-olds in every aspect of his life. And I have to assume that that's why you were just used to dealing with people of a certain age that at least were well-intentioned and maybe had some training, and that is probably, in fact, I'm going to say yes, it was why I wanted to get my CLU. I mean, I have to laugh. Some at least men would grow mustaches because it made them look older. I figured a CLU, I couldn't grow a decent mustache. So I figured a CLU was the way to enhance my credibility to people who otherwise had every right to be skeptical of who is this kid? Or maybe they realize that here's an advisor, if I pick right, will be around as long as I'm going to be around. And I don't have to go shopping for advisors at the age of 92. And there's an element of truth to that too, I suppose.
As we get older, we learn that, we should have chosen doctors that were 10, 15 years younger than us.
Isn't
So
that the biggest issue facing all of our professionals who we all picked cleverly as our peers are all thinking of retirement? And yeah, exactly.
all of my support network is retired. It's like,
That's right. Me too.
I'm now into people in their 30s and 40s. So you've had mentors through your life. How did you find them? Did they find you? Did you go looking?
I probably went looking. I mean, well, I tend to be curious. So I like to read. I like to talk to people. I like to pick brains. And I'm social enough to know that if once again, getting back to organizations like the CLU chapters and the life underwriters and study groups, is if so and so is a guest speaker. I mean, if you want to sort of get my attention, hold an event and have somebody a name as a guest speaker, I'm all over that. Just as because otherwise you wouldn't have the opportunity. And I will say that that is one um, not advantage, but one way that we salvaged COVID years was a Zoom call. Everybody became more available. They didn't have to worry about travel costs. You didn't have to worry about logistics. You just basically set something up, and if the host was kind, they even made recordings of it, and you could view it later, albeit not with the interaction. So yeah, I think that and then there's a lot, people love to tell their story, and whether it's for background knowledge or humor or whatever. I mean, look at the popularity of podcasts. You're listening to two people have a conversation for an hour, 2 hours, sometimes 3 hours. You think there's no way I'm going to be glued to that, and absolutely you're glued to that. If it's structured properly, if there's that blend of anecdote and technical knowledge, it's time well spent.
I remember in the 1980s, Steve Carlson starting a podcast type thing where they send out cassettes every month. And I was interviewed, and no interview could be longer than 10 minutes because they thought that was the maximum attention span of people. Now you're right, 2 hours goes by. Do you mentor other people?
I do. We have younger advisors at the firm here, so that's where a lot of the opportunity is. Um, I think that if someone asked me if they recreated something like LUATC and asked me to moderate, I'd be hard pressed to say no. So if anybody viewing this now or in the future is setting that up, because I just think that as I say, sharing is it creates energy because inevitably, if you're sharing something that has value and that's exciting, your energy level increases. And then if you can see a positive response where whoever you're talking to is getting excited about, yeah, that's going to be something I can try, or that's going to solve a problem, or I can see we could really make work. I mean, there's nothing. We used to one thing in the money business is that there are times when everything is going absolutely wonderfully in the markets and people are delighted, but there's also times when the markets are delivering negatives of 10, 20, 30%, and part of your job is to get them through that. And we always made a point of saying, and this is we started this in the global financial crisis, 2008. We said, regardless of what's going on out there, give every client something positive to act on before they leave the meeting. Even if it was, making sure that your will is more recent than 5 years or something like that. Just a here's an action item that if you do it, you'll feel that you've accomplished something, and it'll take your mind off the numbers. And so we'd have to sometimes come up with ideas. Well, we often came up with ideas. What is it that we can ask them to do, or what can we ask them to research, so that they'll be focused on that instead of what's going on in the market, and they'll have a sense of accomplishment. So you have an abundance mentality or a shortage mentality, a scarcity mentality. And I've always felt that if you can find the abundance, it's a lot easier to deal with, and I think it's a lot healthier for people, and people like to gravitate to positivity too. I think that the client relationship is enhanced, and they share more positive experiences, and then, oh well, I saw my insurance guy today, but it was fine, rather than, oh yeah, I saw my insurance guy today, and it's really interesting what they're getting involved with, and so I've got some homework to do, or now that the curiosity's up and you end up with a referral.
Where do you find your new clients now?
Well, two sources. One is we have practice continuation agreements with a number of solitary. One of the things that we're extremely proud of is we've built an extremely robust infrastructure here at Polson Bourbonniere Derby. We back in 2003, Kirk and I, and in fact, Kirk went to a $1 million roundtable meeting, and there was a 27-year-old Army brat by the name of Stephanie Weiss, and Stephanie Weiss was a management consultant by any other name, and Kirk was very careful with our money, and he said, Paul, I think we got to hire this lady. So she came up from Arizona to Toronto in the middle of February and spent 3 days going top to bottom, interviewing back and forth. And she said that one of the things that you've got to do is not hire another executive assistant, not hire an office manager. You have to hire an executive to whom, in many ways, you are accountable. Whoa, okay. So we sort of wrapped our head around that, and they said, and how much would this kind of a person cost? Now, this is 2003, and it was a six-figure number. And we sort of, are you kidding? And but we back and forth, and we decided, oh, we have to do this, or this, and all of this research has gone for naught. We were so fortunate to find the right person almost right away. We wrote that salary check, but of course, divided by 26 means that you don't have to write all of it at once. And within the year, our revenue increased by more than that expense. In other words, she was free from the get-go. And our expenses flatlined, our HR problems were resolved. Kirk and I were able to focus exclusively on our unique abilities, exclusively on dealing with clients. Our revenue path improved, and so our profitability. And so we today, the model is still, we see 2 or 3 wealthy people a day, and we go home and spend more family time, focus on the things that make sense, and we collaborate more. So if we want a new capability, a new service, a new whatever, it's not where do I learn how to do this? It's who else is out there who is good at this that we can collaborate with. And that makes it so much easier, because you can learn enough to be able to speak the language, but to find out that one of the best people in that field is willing to share a client with you. Like I say, we would never think to get into sophisticated tax advice or legal advice, so or certainly medical advice. So you partner, and as I'm spending more time playing around with longevity, it'll be medical professionals that I'll need to partner with, to collaborate with, and I don't plan on going through med school at this stage of the game. So I think we're way off topic. But so the long and short of it is, for those of you out there who are are looking at the structure that will allow for growth and creativity and energy creation and longevity of your practice, take a look at your infrastructure. Um, you know, what's your back office look like? Who does what? Who's in charge? How much time do you spend, dealing with finding temporary help? I mean, if the answer, first of all, identify what it is you're absolutely the very best at. And if you are the best disability insurance specialist in your area, and you are worried about what server to buy or what cloud service to subscribe to, you are wasting your time and you have the wrong person making that decision because it's you. And I sometimes I look at our overhead, and sometimes our ratios are a little high on the overhead side. But when I look at how I spend my day, I'm proud to say when people ask me, well, what are you doing in this area? I say, I haven't a clue. You're asking the wrong person. I know it's being handled incredibly well, but it's by somebody else in our team that is not me. And here's her name, and she may be able to give you some advice.
You started this by talking about delegation. You're talking about delegation now. Your practice has evolved a lot over the years, and is that a big part of it that you've delegated, or has there been more to it?
Well, I think there's twin or complementary concepts. One is delegation and one is collaboration. Delegation, ultimately, you are responsible. The person to whom you've assigned the responsibility or the task will come back to you, and you will have to do something with it. Collaboration, you have a peer. It's very much side by side. The individual with whom you're collaborating is as good in their chosen field or their unique ability as you are with yours. And so the result speaks for itself, but you have equal ownership, if you will. So as I say, that's typically where you see legal and accounting is traditionally where that is, although a number of advisors, and I believe you've had relationships with people in the past that really aren't comfortable in the income replacement field and would prefer to partner with somebody who's expert in that area. Same with group insurance, same with pension. Um, we've had experience in those areas as well too. So whereas delegation is making sure you have a robust team around you, once again, all expert in their own fields, but ultimately they are accountable to you or to someone that you collaborate with as your management team. And it's it wasn't from the beginning process. I mean, this was part of what I got out of coaching was this concept of delegation. And to this day, I think we all have peers in the industry that complain about things that sure smack of taking on too much. And so what happens is you tend to burn out. I mean, we all have colleagues that have said, I'm done. And it may not be at the age of 65 or 70, it may be at the age of 55 or 60. And if they can financially afford to, they're out of the business. I think if you want to make advice, or if you want to make working with these kinds of people an integral part of your lifestyle long term, my marathon training has told me that you don't sprint in marathons. I mean, you've got to establish a pace, and part of that pace is making sure that you don't take on things that other people are completely capable of doing and should be doing.
Sounds like the judicious allocation of resources, whether financial or time or intellectual, has been a big part of this.
Yeah,
What
100%.
advice would you give to somebody new starting in the business?
Well, I think that too often people uh, grow in response to busyness. In other words, they get to a capacity and they realize, okay, now I finally have to expand my team. I will say that is how Toronto deals with transit. And all I have to do is say, look at the Toronto Transportation Network. We only add lanes to highways 20 or 30 years after they're required, or sometimes we kid ourselves in thinking all we have to do is change speed limits or whatever, and we'll get through this. Well, look at the mess that Toronto's in from a transit point of view. We very much build practices in a similar fashion. The one thing I'm always admiring of South Florida, a place that I visit with because of family, is they'll build the highways first and then they infill with the subdivisions. Now you can argue about highways versus transit, what have you, but the point is that they build in anticipation. So I think people have to understand, and sometimes, first of all, it's essential that you build your team out. And if you do bring on someone, the right people, they pay for themselves so quickly that it is not a cash flow drain. It is not something that's going to have you making payroll from the credit card or anything foolish like that. Is build yourself like a business. Understand what it is that you do best. So there's one is externally is your corporate structure. Number two is understand what it is about yourself that make people trust you and want to deal with you. So a little bit of introspection, goes a long way. Understand that the way that you're going to make more money is to spend more time doing that, not by learning about AI or not by, if you think that you really want to have AI an integral part of your practice, go find an 18-year-old with tremendous tattoos who's just come out of a program where all they know is AI. They will lead you through, and increasingly there'll be other consultants that you can bring on. So I think that's the key is and it sounds like simplifying, yes, simplifying, true, but also build capacity in your firm so that as you grow, you don't bump into things. Because what happens if you become too busy, you make service errors. And in the old days, it used to be an embarrassment. Now, service errors are potential massive legal liabilities. And if you find out that the wrong insurance check is being delivered to the wrong corporate entity because you messed up on the beneficiary designations, or the client is facing an CRA audit because of taxable benefits or things like that, you need to be able to focus. The stakes are too high. And when you're dealing with 10, 15, $20 million insurance policies, I mean, that's a lot of money to misplace. And so be good at what you learn. To our sharing conversation earlier, find a mentor. Um, and if it's not quite a mentor, then join a study group. We're social creatures. We like to share ideas and build your business that way.
How early would you recommend that someone specialize then?
Oh, I think you can start right from the beginning. Because it won't be too long before you can if there's a reason why you got into the business other than I'm looking for a profession and this seemed like a good one, but often it's because of a family event or because you or someone near you is the recipient of a claim, or because you came from a business, like say you used to be an accountant and you did a lot of audits, and small businesses were fascinating because you were talking to the owner about how they created it. So I think almost from the beginning, if there's an area, or you wanted to be a doctor always, and so the medical world is fascinating, and you wanted to, or you have a a sister or a mother who's a doctor, and you see what she's going through, and you want to be able to provide some benefit of that, so you specialize in the medical market. So um, answer those questions, and you'll be specializing sooner than you think.
Excellent advice, Paul. Thank you very much. Next week, we'll be joined on October 10th by Sandy Pollock. Following week by Morty Sachs, who I mentioned earlier, one of the legends in our business. Then by Don Forbes, Michael Lynx, the great Ross Durant, Bill Bell, Miles Posner, Joel Podesky, Paul Williamson, and we'll end the year with Joe Sheehan. We have quite a lineup of experienced agents, all in very different areas of practice. Thank you, Paul Bourbonniere, for sharing your wisdom with us and your knowledge. Thank you, Krista Barza, for your technical support as always. And we hope to see you next week for Meet the Masters of Insurance webinars.